Impatient bulls selling 0DTE puts, part 3. How do you think selling SPX puts has done through our data set?
When have we been collecting data?
That was the trick in the question. How long have the 0-day
Has it been a year? Do we have a year of data?
In about 2 years, 2.5 years.
2 years of data.
Selling puts.
Selling puts.
Puts or put spreads.
That's probably been quite rich.
It's been fantastic.
It's been pretty rich, yeah.
If you knew that in hindsight.
2020, yeah. Man, well, now what is this? Part 3?
Part 3. So we've gone,
3?
yes, we've done two previous on this. We've looked at just selling put spreads and then holding them to expiration. So just looking at them starting in the morning and then like different deltas for the shorts. And those have all been awesome. Then we looked at managing the trades, and really the takeaway there was that if you had the hindsight, of the look back data, you probably don't even manage the trades because it's been mostly up. But those closer at the money put spreads were the best performing. So now we're looking at managing the trades and putting new ones on. We've been doing this as kind of like a reloading, based on the deltas. So you put your 20 delta short option on, you take profits at X amount, and then you reload
intraday.
Yeah, at a new 20 delta. So
you're really
kind of like a roll.
It's kind of, but it's like an intraday roll.
Yeah.
Yeah, it's an intraday roll, and then you start it all over again.
Yes.
Wow. Okay, cool. I'm excited to see this. Let's do it.
All right, let's do it. So one of the key advantages of managing winners early with longer dated trades is the ability to redeploy capital to fresh trades. The 0-day option market in underlying such as SPX is liquid and active from market open to close. So as we continue our exploration of 0-day credit put spreads, it is time to consider what happens if we look to follow up an early morning winner with its second taste of 0DT premiums. So this is closing a winning trade and then starting a new one at different delta parameters and looks. You think this is a good thing, a bad thing? In your own practice, do you just kind of take the money and run? And
I think it would give me anxiety, because if I have a 0-day on, I'm just always just checking I'm checking all the time. I'm like, is it down? So I think just for the peace of mind, I'd have a hard time maintaining the strategy. As well, I don't. My gut tells me more occurrences, low profit targets. Right? More occurrences can be better. Intraday volatility probably typically low on average, crazy in hot markets. So I don't know. I guess let's see. This could be promising.
I'm kind of with you. I like to, be kind of done.
I like to be done.
Yeah, these get really interesting. So I'll do this and then that and then this and then that.
Yeah.
And in practice, especially when you're talking day to day, it starts to get a little bit of overkill for me personally. On stuff that's so binary like this. Some people, they love this and they want to do this all day long, and I'm with you. But for me, I find it a little bit, gets
You're
a little
human
more.
at the end of the day. So.
I am human.
With limited capital as well.
Yes.
So
limited brain power.
Brain power, limited all of it. All right, let's see what this unlimited theoretical trader was able to do.
Next slide here. We're using over 2.5 years of data in the 0-day SPX options. We collect this every 10 minutes. Begin each day by selling a $10 wide put spread at 9 a.m. We do this plus or minus 5 minutes. So this is 30 minutes after the open. So it's 9 a.m. Central. Each day with the at the money short strikes. On those days when this trade reached 10% of the max profit, we closed it and sold a fresh spread at that time with an adjusted strike. So we're doing a new at the money spread. So you're closing one at the money spread, or you're opening it on the open. If you get the 10% of the max profit, you close it and start a fresh one.
And that's a very low profit target. So the pops on that are probably quite high.
Well, but these are at the money spreads. So you're selling $3, $4, $5 in credit. So you're targeting 50, 60, 70 cents, depending on what the spread is. So it will happen quickly because you're very directional with the trades. But these are pretty meaty spreads.
Yeah.
So we're going to analyze the performance of these second trades only. So we've looked at the first trades in the previous sessions. So we're only looking at the second trades here. And we're bracketing them by the time of day they were entered. So we've been looking at kind of different times of this second trade. So typically it's like the before 10 a.m. So this is if you close your winning trade in 30 minutes or so. Between 10 and 11, 11 and noon, and then afternoon. So this is based on how long it takes you to get your 10% from the first trade.
Gotcha. Okay.
And so we repeated this analysis looking for 20% of the max profit instead of 10%, then using 20-point wide put spreads with short strikes at a 25 delta. So we're also looking at higher profit targets as well as wider spreads, further out of the money, wider spreads. So we're giving you a little bit of everything. We're giving you quick profits on at the money spreads and wider, further out of the money spreads. We're going to look at both of them and see kind of what we find here.
Cool.
So you'll see through all these, being directionally correct is obviously an advantage, and over the last 2.5 years has been quite beautiful here. So the first slide here, we're looking at the $10 wide at the money short spreads closed at 10%, and then we're looking here again at the second trades. So when you look at the whole batch together, all of these are very high probability. You're looking at 90% plus across the board. I mean, if you do these trades afternoon, it's been the trend is your friend. Average P&L per trade around that $40 mark, which is pretty solid for this is the second one. So we've already managed the first trade. But the point being here with with the market the way it's been, which has been mostly up, trading directionally bullish has been fruitful with all of these trades.
Oh yeah, then in those rare instances when the market just dumps.
Yes.
But these are spreads though. So you have your defined risk and there's also usually context around those moves, right? So that you can kind of be aware of that and adjust your trades accordingly. The first thing that stood out to me was just the number of occurrences placed before 10 a.m.
Yeah, so this is 30 minutes. And that
this is 30 minutes, yeah.
What does that tell you about what happens in the first 30 minutes?
Ooh. Bulls running amok.
Well, it's been mostly up.
Yeah.
So like a lot of these occurrences, for you to get a 10% profit on that at the money spread, you need the market to go up.
Yeah.
And so you've had that, 400 times where the market was probably up, the magnitude of, let's just take a delta for as our proxy here. You're at the money spread in SPX. Just so let's see what a delta would be. And this is into a pop in volatility, but you're doing a $10 wide spread. You got about 9 deltas on that trade. Mm-hmm. So you're getting at 9 deltas for you to close that for 50, 60, 70 cent profit. You need the market to be up, 10 points in that first 30 minutes.
Yeah. But look at that. We've also had kind of an abnormally bullish market, and that's not always what we tend to have for long stretches of time, especially when you're getting into intraday volatility. There's a whole bunch of nuances there. There's a whole bunch of nuances there to take into consideration. But the data, just looking at the last 2 years, it's been really interesting. But yeah, before 10 a.m., that's crazy.
Yeah.
Not surprised, but yeah, bananas.
The next slide here, we're looking at the same $10 wide short for the short option going $10 wide. Now we're closing at 20% of the max profit. And then the data here is of the second trades. You can see all your probabilities kind of come in, and because there's going to be less occurrences here because you're managing at a higher profit potential, of course.
For sure.
Your average P&L goes up as long as it's happening very quickly. So again, this is one where the trend is your friend. If you're getting the profit early,
right,
putting it on, it tends to start working again. If it takes you a little while, because you'll see, between 11 and noon and then afternoon, your numbers get a lot lower.
They get a lot lower. Everyone just goes to lunch.
Is that it?
I don't know. Maybe that's it.
You just trade in the morning, then be done.
Then you're done. Then you go get your chickens and salads.
See, I think that I agree. I mean, that's what we do here until we come back for last call. But
the fact that you're seeing most of these over 90 is still crazy at 20%. That's awesome.
And you have the weird 11 a.m. to noon time frame where that's just kind of a volatile period of time. Jajun did his research on that on that little spot. That's kind of like the time where you can, where you can see the peak volatility is kind of the
Maybe the people with normal brains go to lunch, and so it's just the degens taking over.
That's right. The big liquidity goes to lunch, and,
Yeah.
and then us degens are here.
Little liquidity just out here running amok. Yeah.
It's funny to see, and you'll see that that time frame on all of these charts is the low period. Like that's when you see volatility,
Wow,
which is
great.
kind of. But again, this is just the last 2.5 years.
Yeah,
so this
very
is,
limited time frame, abnormally bullish market for a lot of that.
Yes.
Although we've had some chop too.
Yeah.
Yeah, look at that. Wow.
What do you think the market overall has done in this time frame?
In 2 years?
2.5 years. What do you think
gonna
SPX
throw
does?
up.
2.5 years.
Just like total percent gain in the S&P?
Yeah.
In 2 years? We normally average 10% a year.
It's been a lot more than that.
Like closer to 9, actually. I'm going to say, 40?
I think the low to high was 3,800 to like 6,800.
Well,
Which is where we're at right now. You know,
I
SPX
love the
6,800.
future.
Yeah. So
That's
it's
crazy,
been,
dude.
it's
We
been,
average 10% a year. That's nuts. In 2
that's
years.
the range,
Yeah.
I don't know the exact, like when you do it from open to open, but it's been,
Crazy.
yeah, you look at that 2-year chart and it's a beautiful, beautiful thing.
Well, you know.
So next slide here, getting into the, so we'll get to the 20-point wide. So this one, you obviously are getting wider spreads. You're getting, there's more total risk on this trade, which is a lot of the reason why these numbers aren't as big for your average P&L. You're selling these for less premium. You also have more risk. And so these are bound to be a wider distribution of P&L, which is why you're seeing these trades as an average P&L be lesser. But you can see across the board, it's still been positive. So a win rate, 97% of all the second trades. So you basically are winning every single trade with these pretty small losses here. But again, the losses are going to be tail losses.
Yeah.
And this is with all the stuff that we talk about with 0-day trading. The main takeaway is that you have to be able to withstand the drawdown and that P&L variance. And a lot of people that I talk to that get caught on these sort of trades is they start with doing 1 or 2 or 3 contracts. And then, this is free money. This is the free money glitch. I'm going to do 10, 20, 50
Scale
contracts.
up, get a little greedy.
Get a little greedy.
Get a little greedy, yeah.
Why do I close this trade when it's, it's only goes up? And then you get whacked on some of them. And then, you got to keep the doors open.
You need the discipline.
Yes.
You got to have the discipline, especially with 0-day trades. They got to take a tiny amount of capital, if anything.
Very true.
Look at that.
Yes.
98% though is nothing to sneeze at.
Yes.
Yeah.
This has worked. You've had a lot of second trades here too, just because, these are further out of the money spreads, so they decay a little bit quicker. And if you're going for 10% of the profit on these, it's going to be a much smaller number. You're talking about 20, 30, 40 cents as opposed to the 60, 70, 80 cents that you would be looking at with an at the money spread. So that's another part of the equation here. But again, that 11 to noon time frame, that second trade.
One went to lunch.
Yeah, just wait until afternoon if you're going to do that one. So
Jeez. Yeah.
pretty wild that has been kind of the funky spot there.
Funky junky. What else we got?
Last slide here, takeaways. Or I'm sorry, we got one more. Yes, we got one more with the closing at 20%.
Yeah.
So this is oh, John. Wow, you come back.
You got the sad horn.
I couldn't see the 5. Now they're really.
I'm glad that someone around here is having fun.
I know, right? 20% of the max profit. So we're closing at 20% here. You can see these numbers get a little bit better. There's a lot less of occurrences here because you're targeting higher profit potential. But overall, all these things have been good. I think we've put to bed the put spreads have worked in hindsight very, very well.
In the last 2 years.
In the last 2 years.
In this pretty bullish market.
Yes.
Yes.
So just keep that in mind.
Yes. Very cool stuff.
Last slide here. Now we're on the last slide for the takeaway. So being directionally correct is an advantage. How amazing is that?
Whoa, my God.
It's groundbreaking.
If you're always right, it's great.
There have been very poor ways to sell. There haven't been poor ways to sell SPX puts recently, but that shouldn't stop us from looking for the best trades here. So winning credit spreads coming off before 11 a.m. and starting a new trade was an effective way to increase daily profits. Again, it's been an up market, so doubling down on trades has generally been good. Trades placed later in the day, however, were less successful as there was very little credit left to sell, especially for the out-of-the-money trades. That was kind of what we saw with the 11 to noon, and then even the post-noon time frame for the second trade was a lot less profit, average profit overall, and your win percentage was much lesser. Not a shock there because premium decays and you'll have more risk on a lot of those positions. Every day is a new set of opportunities for zero-day traders, and when those opportunities pay off, especially quickly, you might even get more than one winner in a morning. So if things work quickly, it kind of has paid to double down again quickly.